Let's jump right into this explainer. Today, we're taking a player's virtual quest for wealth and using it as a literal masterclass in real-world finance. Sounds a little crazy, right? But honestly, the digital economy inside a massive multiplayer server perfectly mirrors the high-stakes, cutthroat environment of Wall Street. We're going to track one player's absolutely grueling journey to scale their net worth, and man, it uncovers some profound truths about how markets actually operate, how our own psychology trips us up, and what it really takes to build massive wealth.
So, here's our game plan for today. We're looking at 6 core concepts: passive income, the sunk cost fallacy, market arbitrage, supply and demand, the high-risk gamble, and finally, the crucial difference between investing and speculating. Let's get into it.
Starting off with Section 1, the quest for passive income.
Okay, any good investor knows that simply trading your time for money has a hard ceiling. To truly scale your wealth, you absolutely need systems that produce capital while you're sleeping. And our investor here is attempting a massive industrial-level leap, trying to scale their net worth from $100 million all the way up to a staggering $250 million. You know, you can't just run around picking up loose change for a leap like that. You need serious capital expenditure to build a fully automated production facility.
But building a stacking raid farm production business, it comes with some absurd operational complexity and a massive barrier to entry. First off, natural resources, villagers in this case, were depleted, so our investor actually had to go source a zombie and manually cure it. Then, they had to engineer these intricate hopper clocks, sync up TNT mechanisms, and carefully manage spawn rates. If you think about it, on Wall Street or in manufacturing, this is the exact equivalent of navigating complex zoning laws, securing incredibly rare raw materials, and fine-tuning an entire supply chain. It demands a huge upfront investment of time and effort, all banking on a high yield later down the line.
But, well, things rarely go perfectly to plan. Bro, I could be outside and playing Minecraft. I mean, that single thought right there perfectly captures the absolute agony of realizing you have a terrible return on your investment. After days, literally days of trying to get this incredibly complex machinery to work, the farm was netting a totally miserable $6 million an hour. When you factor in the sheer amount of labor involved, the profit margins were practically non-existent.
Which brings us to Section 2, the sunk cost fallacy.
Look, when you pour your heart, your soul, and your capital into a project, walking away just feels like absolute defeat. And this leads straight into the sunk cost fallacy, which is the reluctance to abandon a failing strategy because of all the time or money you've already invested, even when the ongoing outcomes are just poor. Our investor completely fell victim to this cognitive bias. The server mechanics were causing local clocks to run 12 times faster than normal, totally destroying the farm's timing. You had witches surviving TNT blasts, healing other mobs, and spawning hundreds of flying vexes. It was chaos. Yet our investors spent days battling this broken system, flat out refusing to walk away simply because they'd already spent so much time building the thing.
So, we're looking at a literal graveyard of bad investments here. The ominous bottle farm? Terrible profit margins. The tree farm? Way too operationally complex and actually required multiple people to run. And that flagship raid farm was just plagued by broken mechanics and a devastatingly low yield. This leaves us with a highly valuable financial lesson. Sometimes the absolute best business decision you can make is to simply cut your losses. You cannot let the time you've already spent dictate the time you're gonna spend tomorrow.
Moving right along to Section 3, arbitrage and market flipping.
Having finally accepted the sunk cost of those farms, our investor makes a massive pivot, completely abandoning physical production to enter the financial market directly. Just compare the grueling, high-effort labor of farming to the highly lucrative world of market flipping, or what Wall Street calls market arbitrage. Arbitrage is really just taking advantage of a price difference between two different markets. Our investor noticed that players were selling massive quantities of emerald blocks super cheap for instant cash, while other players were placing huge bulk buy orders at much higher prices. So the strategy was dead simple: buy the cheap emeralds and sell them right to the high bidders.
Now, a successful arbitrage cycle requires real precision. First, you analyze the margins to find your edge. Our investor realized they could buy emerald blocks for $12,000 and turn around and sell them for about $12,200. After buying 100 stacks and just waiting for the market orders to fill, they literally turned that initial buy-in into millions in profit. They weren't creating a single new product, they were just acting as a liquidity provider, bringing much-needed efficiency to the market and taking a really healthy cut for their service.
All right, Section 4, supply, demand, and patience.
But here's the thing. Having a brilliant mathematical strategy is one thing. Having the psychological discipline to actually execute it is another. In real time, our investor wrestled with classic supply and demand mechanics. They listed this massive stockpile of emerald blocks at 1.2 million per chunk, but the volume was just way too high, and nobody bid immediately. It's the classic financial dilemma, right? Do you hold your price and wait for demand to catch up so you can maximize your margin, or do you lower the price just to free up your capital faster? Well, out of sheer boredom and impatience, they panicked and dropped the price down to $999,000.
And wouldn't you know it, shortly after selling at that steep discount, market demand surged right back and prices shot straight up. Patience could have made me 20 to 30 million. Prematurely lowering prices out of sheer impatience literally cost our investor tens of millions in lost revenue. In the world of finance, patience isn't just some virtue, it is quite literally a heavily compensated skill.
Which leads us to Section 5, the high-risk gamble.
The slow, methodical grind of investing eventually faces the ultimate temptation, 220 million. Our investor grinded their way to this staggering figure through all those calculated market flips, sitting agonizingly close to their $250 million goal, just 30 million away. But, fatigue really set in. The impatience of constantly checking the auction house, waiting for buy orders to fill, constantly analyzing margins, it all kicked in hard. They just wanted to cross that finish line.
So instead of continuing to trade with a proven statistical edge, they turned to a coin flip gamble against another player, a pure double-or-nothing bet. And this is a terrifying prospect, especially when you consider this exact same investor had previously lost $1.5 billion from 3 consecutive failed bets. I mean, they went from 400 million, gambled their way up to $1 billion, and then lost it all in one devastating streak. The history of ruin was staring them right in the face.
But they took the bet anyway, and they actually won, finally crossing that 250 million goal. But look at their immediate reaction. It undercuts the victory entirely. Do not gamble. I know it looks great, but you just gotta stop. It serves as this massive, glaring warning to all of us. The intense psychological stress, combined with the mathematical reality that the house always wins long-term, made this a totally hollow victory.
Let's wrap up with Section 6, investing versus speculating.
I want to draw a hard, definitive line between the two wealth generation strategies we've just witnessed. People confuse them all the time, but they couldn't be more different. Flipping those emerald blocks, that was a calculated investment. It was edge-based arbitrage where the investor analyzed the data, provided market liquidity, and had a very clear mathematical advantage. The expected value was strictly positive. On the flip side, that final massive coin flip bet was pure, unadulterated speculation. It was a blind gamble with a negative expected value over the long run. One of these builds generational wealth, the other absolutely leads to ruin.
So whether you're managing a corporate portfolio, running a small business, or just trying to optimize your own personal savings, I want to leave you with this. Have you ever held on to a failing strategy just because you put too much time into it? Look closely at exactly where you're putting your capital and your time. Ask yourself right now, are you actually investing with an edge, or are you just rolling the dice?